Investors be positioning themselves ahead of this afternoon's big meeting? We want to bring in Rady, CEO and Portfolio Manager at Rady Asset Management, and also Jim Urio, Managing Director at TJM Institutional Services. Great to see you guys. Jim, you know, there's a couple different ways you can look at this. Typically, markets don't like the idea of interest rates going up. But there's another school of thought that says, you know what, we need to do a little bit more in terms of the dollar. We need to show that the Fed has an exit strategy, etc. And so some people actually think it could be a positive sign for the markets. Where do you come out, Jim?
I think longer term it could be a positive sign for the markets. Shorter term it would not. I don't think it's going to matter, though, because I don't think there's going to be much that's going to go on in short-term interest rates. Just a couple days ago in these short-term interest rate pits behind me now, there was enormous hedges being put on in case something hawkish comes out of the meeting today. Then you go back to yesterday, we saw a lot of dollar buying, which seemed to be the same sort of thing. I think they're all going to be disappointed. What I do think is possible, though, is that the Fed might talk a little bit more about liquidating their balance sheet as far as the long end that they have on their books now. To me, that would be an excellent way to kind of take liquidity out of the market without, you know, because Larry asked the question before, why are they not going to move rates? I mean, to me, it seems like they still think the banking system is a little bit fragile. If we stop force-feeding them the money that's coming from the steeper yield curve, how many of those banks are going to go belly up? And I think that's still something to them. But they can raise long-term rates now, which is a little different by selling out that stuff. So I think the individual investor takes advantage of that by buying something like the TBT ETF, which I'm long right now in case those long end rates start to go up a bit.
Harry, what if they removed extended period? I know that's a long shot, but what if they removed extended period from the FOMC statement today at 2:15? What would the market reaction be?
You know, we don't think that the risk is in the FOMC or the Fed. We think that the real risk is on the unexpected, as in our reliance on foreign buyers. You know, we just think that given how low rates are and the expectations that rates will continue to be where they are, we just think that the market is vulnerable to unexpected shocks. I mean, what if China decides to change their policy and pull back on
That's a great point. Can I just ask you, that's a great point. Can I just follow up real quick? Look, what if this China thing, you're absolutely right. China tightening its credit, that's number one. Number two, a U.S.-China trade and currency war. We are not far from it. You read the headlines from yesterday and today. Yeah. A trade and currency war with China. Much more important than the Fed. What would that do to the stock market?
Oh, I would say that there'd be at least 10% downside. And, you know, we agree with the other guests. We're long the TBT, but we're a long-short mutual fund manager. So we're positioned to take advantage of.
Harry, let me just back to what Larry was saying. I mean, it seems like in some ways we're looking at history potentially repeating itself in the way of the Smoot-Hawley Tariff Act going back to the 30s. I mean, when we look at the potential trade wars with China and we try and factor in what interest rates are going to mean in all of this, where do you come out?
You know, I just don't think that the risks are adequately discounted in the market. I mean, in addition to China, there are a dozen other potential shocks, yet rates are trading at historical lows. It just doesn't make any sense to us. I mean, we think long rates ought to be a good 200 basis points higher to take into account the potential for China, the potential for inflation, and for the unexpected for...
Jimmy Urio, it's just such an interesting point here. Look, the yuan and the dollar are linked and have been since the crisis started in 2008. Maybe China is the Fed. Maybe China is the one that's tightening credit and tightening money and tightening interest rates. Maybe China is doing what our Fed is doing because our Fed doesn't have any chutzpah, otherwise known as chutzpah, and they don't have a real keister or a backbone or cojones. Think about that. Maybe China is going to do it for us. What does that mean for the stock market?
There's no question about it. And last week when they got the bad inflation data, now we're going to start the buzz about the reval again, too. That could hurt the dollar. Now, this is where we get the interesting dichotomy, though. If they let their currency reval and it hurts the dollar, do people start going back into stocks because of that? I say no. I say that relationship at some point in time breaks off a little bit, and we could see a little bit of a down move in the stock market because of China.
Okay. Larry, that was one interesting way to put it. Okay, thanks, guys. We appreciate it. By the way, you can catch Jim Yorio on Options Actions. It's Friday at 5:30 p.m. Eastern, right here only on CNBC, your fast track for option and equity trades. Melissa?
Up next, OPEC oil ministers gearing up for tomorrow's big meeting. Could their latest guidance stall the economic recovery? We're going to drill down on that.
It's chutzpah, actually. It's not chutzpah. I got that wrong. And housing battles back. Real estate experts from both coasts are here to tell you which areas are back